Hey, everybody, welcome to the morning market briefing. It's Monday, August 29th, 2022. Hope you had a good weekend, all that stuff. Plenty of red as we kind of survey the market on a pre-market basis. Dow futures down 81 basis points, S&P down 91 basis points, NASDAQ's down about 1.1%. Gold down a little, silver down a little, crude oil up just a tick. We'll certainly get into market implications specifically on the equity side in a moment, but we're going to open up with Jackson Hole and what we heard. We did hear from Jay Powell, Fed chairman, on Friday. Tom, I want to start with you. Kind of high level observations. What stood out? What was noteworthy?
I think the big takeaway, I think everyone was anticipating some sort of splash, whether it be a pivot, whether it be changing the inflation target, or whether it just being a real firm stance one way or the other. And honestly, I thought it was kind of a nothing burger. I mean, we watched it all together. It was about 9.5 minutes long. And I didn't think that Jay Powell really said anything that we didn't know. Though the market reaction was extremely hawkish, was basically implying that they were going to raise to the moon. Though if you look at interest rate futures, that really doesn't appear to be the case. Right now, we're still kind of in that mid-range between 50 basis points and 75 basis points in terms of the next rate hike. But there were obviously a lot of, sort of gloom and doom statements that I didn't think he said with much authority that were kind of taken as being the end of the stock market as we know it. It's at least in terms of how the market moved in the afternoon. But he basically said, there's got to be a sustained period of discomfort for households and for businesses because they need to raise rates and keep the foot on the brake on the economy in order to rein in inflation. He said, quote, "We must keep at it until the job is done. History shows that the employment costs of bringing down inflation are likely to increase with delay as higher inflation becomes more entrenched in wage and price setting." So basically saying if we don't basically make it so people get fired, we're going to continue to see wage inflation as people look to fill those higher level jobs or even just change jobs in order to get a little bit of a pay bump because there's such a strong force there in terms of upward pressure on incomes in the employment market. He basically said also, quote, "Reducing inflation is likely to require a sustained period of below trend growth, aka, we're going to put some real pressure on the economy. Moreover, there will likely be some softening labor market conditions. While higher interest rates, slower growth, and soft labor market conditions will bring down inflation, they will also bring some pain to households and businesses." So that's basically, I think, probably the one line that was taken very, very strongly by the market. If you look around, interest rates didn't really move that much. We saw a little bit of steepening in the sense that the 2-year treasury was up, a few basis points, and the 30-year treasury was down a few basis points, but ultimately we were really unchanged. So a lot of that hawkishness, at least on the bond side, was already baked in, and there were no real surprises there. But I don't think that he was really convicted in saying we're really going hard at rates. I think he said a couple statements that were, he basically compared himself to Paul Volcker saying, we're going to do what needs to be done. But if that was the case, they would raise by 3% all in one shot. So I don't know. I'd be interested to hear your thoughts, Ben, your thoughts, Andrew, because I thought it was a very strong reaction to something that was pretty
weak.
Yeah, it was very, very tempered in my opinion.
Yeah, not only that, but even the things he did say, regardless of the inflection or kind of the way in which he said it, even reading through our notes, if you read them in bold, all of these things make complete and perfect sense. They just haven't really wanted to say them. Yeah. And as you mentioned, like it seems like on the bond side, a lot of this has been priced in. I was very surprised by the equity reaction. Ben, before we get to that reaction, what's kind of your view on the commentary that was given?
Yeah, I thought he kind of mailed it in, kind of like what Tom was saying. I thought it was extraordinarily short. He didn't really say anything. He was basically playing Jay Powell, the reporter. There was little analysis that he had to say. And I think that he did give himself an out if the economy really starts to buckle. And basically, he is pleading the fifth in terms of taking responsibility for any market drop, any economic drop. He's saying it's necessary. If it happens, it's part of the plan. And that's a good thing. And you can't say that Powell didn't see this coming because he said it could happen. And so I think he's basically giving himself an out there. I think if I really had to broaden out a potential motive for how he came across, I think he's trying to scare people. frankly. I mean, I think that he's trying to scare people to reduce consumer confidence and reduce aggregate demand, because when people are scared, they're not going to buy a house. And we hear it from clients all the time. Should I invest? Maybe I should go to cash. Maybe I shouldn't buy that house. Maybe I shouldn't buy that car. Maybe I should wait for car prices to come down. Housing has peaked. I'm not going to buy. And when that happens, you lower aggregate demand, which is ultimately what the Federal Reserve wants to do. Typically, the Federal Reserve would lower aggregate demand by raising interest rates, but clearly they're reticent to do that as aggressively as Tom suggests they need to. So in lieu of that, they're going to instead try to scare people to bring that consumer confidence down and use rhetoric to reduce aggregate demand. Whether or not they can do that, it's an unanswered question, because we haven't really seen this happen before. I would say that it brings up two thorny issues. One, you play with consumer emotions. You're playing with something incredibly fickle. They tried to scare people in May, and that did bring a slowdown in June. But we saw, just as soon as people started to get a little bit more calm, spending resumed again. Inflation's kind of picked up again. And then on the flip side, there's no safety net at the bottom. If you're scaring people and you're reducing consumer confidence, that might achieve your aims right now. But
how do you
to
get
reverse that? Yeah, you got it. Jay Powell has to basically be an economic soothsayer at some point. And I don't know how effectively he'll be able to do that.
Interesting commentary from Goldman. They note that his speech really reiterated that it will be appropriate to slow the pace of tightening at some point. They expect a 50 bip hike in September, 25 bip hikes in November and December. But they note that the risk is really to the upside. I mean, I agree with the risk being to the upside. I think we're going to continue to get kind of those triple hikes. Tom, curious if any of your thinking and your expectation for September and beyond has changed based on what we heard last week.
Not at all. I think if anything, we've got to continue to skew hawkish as the more probabilistic outcome. We're right at like 2.7 hikes estimated on futures right now. But if you look behind that, we're basically looking at another 2 for November and then another 2 for December. So, ultimately we maybe added a total hike in there, a little bit on the average. So it kind of depends on where the Fed is thinking, where that actually comes. But, I would expect at least 3 for this one, if not 3 for the next 2. But, I think there's going to be a point either in November or December where they maybe tick down to 50 basis points. But I think that Goldman's off on that. I just don't think that that's a realistic outcome, that they would restrict already in September and then cut down for December and November as well.
Ben, as we think about kind of the market impact, we talked about how drastic that was on equities. How do you kind of digest what we saw in the afternoon on Friday?
I thought it was a remarkable fall apart from the equity markets, and especially considering that the markets had been relatively weak over the past week and a half. I thought a decent amount of this had been priced in, especially in the absence of Powell actually saying anything of consequence. If you look at other markets, there was no freak out like we saw in equity markets. And I'm not talking about equity markets internationally, because we are seeing some follow through here this morning in sympathy with the US fall down from Friday afternoon. But if you look at currencies are flat. The euro was dead flat on the day. Bond yields were basically flat. They're up a little bit this morning, but not a whole lot. They're only back to Thursday levels. Bond volatility, interest rate volatility is actually down. And expectations for rate hikes were essentially flat from where they were at the beginning of the day Friday. So there wasn't really any market-based thinking change on what the Fed is thinking. It was all just equity freak out, primarily probably as a result of how negative Powell said that the economy could get. And I think that as that realization sets in, I think we could see potentially some more equity declines. But again, this is a confidence related concern that happened on Friday afternoon. I think it's following through this morning.
Yeah, very much so. We're also seeing energy remain an impact, especially abroad. Regardless of what your view on Friday's activity was, Ben, you've made it pretty clear that you still think we're in this bear market. And although we had some relief for a couple of weeks, the market's still kind of looking for pessimism.
I do, and not that we're in a terrible situation right now, but just the fact that it continues to deteriorate. And frankly, the longer the inflation continues, and I do think that the inflation is broadening out a little bit. I mean, I see it when I go to the grocery store. The longer that inflation continues, the more pain that will be inflicted, especially at the lower end of the American consumer. And I don't think that the large economic data are picking that up just yet, because frankly, the lower end consumer doesn't really move the needle a whole lot for the overall economy. But I am concerned about the pain that person is feeling, the households that rent, that have a large portion of their income go to groceries. I think that they're really feeling a lot of pain right now.
Interesting story out of the airline space. Bookings took a really significant step back for the week ending August 21st, down almost 24% relative to where they were in 2019. For context, the prior week reading was down about 9.3%. This is a significant downward spike, at least in the trend data we've had lately. Ben, how would you digest that, and what do you think the threat is?
I think it's exactly what we talked about with why people are taking a slower approach to buying cars and buying homes. It's because people have been scared into not purchasing. And, don't plan a very expensive vacation for fall break or Christmas break at this point in time, because you don't know how the economy is going to evolve. So I think that's probably a driving factor. I wouldn't be surprised to see a little bit of a rebound here in the next couple of weeks, but we'd have to rebound very strongly in order for a lot of these airline companies to be able to hit their Q3 numbers. So I'm curious to see how that happens, and if there are any downgrades of airlines coming in the next few weeks.
On the upcoming week ahead, quite a bit of employment data. We will get ISM manufacturing on Thursday. But tomorrow we'll have the July JOLTS job openings data. A little bit of a delay there on some of the reporting, so not totally sure how useful that'll be. We'll get ADP employment on Wednesday and the unemployment report on Friday. What's standing out to you guys is the big one? I mean, it seems like Friday would be the one to keep an eye on, but do you expect any kind of surprise there?
I mean, really, for me, I'm interested to see what the differences are across the board, because we've seen some stark contrasts in some of these months where ADP is looking one way and then the Bureau of Labor Statistics is entirely different. And, I'm interested to see what the reaction is to each, because if ADP, say, potentially comes in very strong again, how is that going to be read? Because I think we're going to be in a situation where good news is bad news. A strong labor market is going to indicate stronger action from the Fed. And so if ADP comes in really hot on Wednesday, is there going to be a reaction, or people are going to sort of shrug that off and wait for the BLS report on Friday? And how's that going to look? If there's a big difference, which one is going to be the correct read?
And I would argue that the ADP report will basically be a non-market event, because they're retooling this month. They've retooled. They spent the last 2 months retooling how they actually go about calculating employment. And so I think this will be very much a testing ground. And I think that whether it's good or bad, I'm not sure that the market will really respond to that in a very big way. It's going to be an indictment on ADP if they're not close to the BLS number this time, though, because they spent the last 60 days rejiggering their algorithms.
Awesome. Good stuff. We're going to wrap it up there. We will be back tomorrow morning at 8:30. Hope you guys have a great day and a good week. Talk to you soon.